Happy Friday, friends. It's Shayan with Integrity Home Mortgage, back with your rates rundown for April 3rd, 2026. There's green on my screen. Not for the day, but markets are improved week over week, and that's the first time we can say that in a while. The trend for the week is being driven by sort of a shifting in broader sentiment, while the day is really more of a reaction to specific data. But before we get into that, let's take a look at our benchmarks. Since last Friday, 10-year Treasury yields are lower by about 11 basis points to 4.32%. And mortgage rates are also lower by about 19 basis points, bringing them back to just around 6.6%. Um, any recovery is a welcome development. But while this week has been an overall positive for long term rates, since February 28th, 10-year Treasury yields are still higher by about 40 basis points, and the 30-year fixed rate mortgage rate is up by over 50 basis points. This, truthfully, is among the sharpest 4 week rate increases I can remember, and I've been doing this for a while. As predicted, mortgage activity has in fact fallen off a cliff due to these higher rates. Mortgage applications are down double digit percentage points for the third consecutive week. That's being led, of course, by refi demand, but purchase activity remains sluggish too. We're still kind of early in the spring selling season, so I guess there's a chance that the housing market could make up some ground, but affordability is going to be a huge obstacle. According to Zillow, these higher rates have wiped out 30% of the affordability gains achieved since the day before the war started. Of course, the conflict in Iran and the resultant impact on oil prices continue to be the main driver of weakness in interest rates. The good news is, while oil prices hit their highest levels since the start of this war this week, Treasury yields and mortgage rates have not kept pace with that weakness. This is potentially an early sign of stabilization for long-term rates. It partially can be attributed to some optimism that the war will come to an end in the next few weeks, based not only on the president's own timeline, which he announced in his primetime address to the nation earlier this week, but also ongoing talks being mediated by Pakistan. Truthfully, those talks don't seem to be going real well, but I guess the fact that they're happening at all can be seen as progress to some. Also, the notion that the war itself may weaken the economy enough to lower overall consumer demand and thus warrant lower rates in the future. Maybe that means recession, maybe it doesn't, but gas prices are up over $1 on average, and that's bound to change some consumer behavior. So while oil prices continue to reflect a sustained supply disruption, rates investors are slowly reducing the premiums that they have been demanding due to geopolitical risk. And that's what's kind of putting a cap on long term interest rates, even as oil prices continue to rise. So that takes care of the shifting sentiment part. Let's review the data that has rates markets weaker today. Today's Good Friday, and markets are usually closed on Good Friday, but they were open today until noon because today was also Unemployment Friday. And unlike last month, where the jobs data was a huge disappointment, today's non-farm payroll numbers came in much stronger than expected. The economy added 178,000 new jobs, which was three times the consensus forecast, and the unemployment rate ticked back down to 4.3%. That sounds like good news, and it is, but it's also news that indicates that perhaps the economy is stabilizing rather than stalling. So, why is that a negative for rates? Well, before this report, many investors were betting that despite inflationary pressures being caused by oil prices and tariffs, a weakening jobs market might just be the thing that would force the Fed's hand. Now that assumption's kind of out the window, along with the chances of another Fed rate cut pretty much at any point this year. On the positive side, despite inflationary pressures building with each passing day that the Strait of Hormuz remains closed, investors remain confident that the Fed won't need to raise rates either. And that's because this run up in rates is that we've seen over the last 4 weeks is doing that work for them. So there's no real reason to raise rates if rates are raising themselves. That's all I've got for you guys this week. Have a great weekend. Happy Easter to all who celebrate, and we'll see you next time.